Ebo.
We are about to go live.
Kofi, you're muted. On today's webinar that we've planned for you. We want to extend sincere gratitude to everyone that is joining us this morning. We understand that you have busy schedules, but have made time for this conversation, and so we are grateful for your time. For those of you joining us on our social media platforms, you are also welcome, primarily on Facebook and on YouTube as well, on Petra on Social. My name is Solomon Otu, and I will be coordinating the discussions today. And today's webinar is all about what we are to do in uncertain times, making sound financial decisions. And I believe that that is the reason why most of us are here today. So hopefully we walk away with some understanding and some direction as to what to do by the time the discussions are over. I'm not here alone. I am joined by very distinguished personalities who will be helping us to dissect some of the questions that are on your minds. And hopefully by the end of the day, we should all have some satisfactory guidance and direction as to what to do. So today I'm joined by Mr. Kofi Finn. He is the Managing Director of Petra. Mr. Kofi Finn has been in the financial space for quite a long time, for over 14 years, managing assets, and he's joining us today with his wealth of experience to help us understand what we are to do in these uncertain times. Joining him also is Mr. Eugene Birkuran. He is the current General Manager of Petra Trust. We believe as key members and as other people who are joining us, you will want to understand what Petra is doing in these times to help you to manage your funds and to safeguard your funds. And so Eugene is here to assist us with questions in that light. And so Mr. Finn and Mr. Birkuran, you're welcome this morning. A few words to share with our audience.
Well, let me start. Thank you so much, Solomon. Thank you everyone for joining this webinar this morning. When Solomon was introducing me, somebody sent me a WhatsApp to say I was looking too serious and I should smile a little bit. So I'm trying to do that. But these are serious conversations that all of us are having in our homes, given the current environment we're in. There's a lot of uncertainty in the market around what's happening to the country's economy, what's happening to the financial sector, and what the impact of that is going to be on us as individuals. And I'm looking forward to sharing some thoughts and ideas with all of you about how we should approach this. And so hopefully it will be useful to you. And thank you very much for joining.
Thank you, Kofi. Eugene, any
yes,
words
good
for
morning,
audience?
Good morning, everyone, and you're welcome to this series. I believe the times are calling for such interesting conversations. We started these conversations way back last year to equip members with information to make right decisions. And I believe times like this call for such things even more deeper. So I'm actually happy that we've been on this journey. If this is the first time you're joining us, you are most welcome, and I'm looking forward. We need more expertise, we need more learning, we need a lot more care in taking financial decisions, most importantly, even around these times. And I'm looking forward to insightful conversation that will equip members and general customers in how to steer in these times. Thank you.
Thank you, Eugene. Thank you, Kofi. And once again, you're welcome. Just a few housekeeping rules. As the webinar is going on, if you have questions you want us to address, at the top right corner of your screen, for those of us in the webinar, you will see a Q&A button where you can click and then submit your questions. In the course of the webinar, we will address those questions as they come. For those of you on YouTube and on Facebook, you can indicate your questions on the comment section, and we will address those as well. We have people standing by to assist to address those. So please do not keep your questions to yourself. Ask as many questions as possible to give you the clarity that you need to make the right decisions. Okay. Again, as Eugene mentioned, if this is the first time you are joining us, this is not the first webinar we've had. This is the third in a series that we've had so far, and we are hoping that you will be able to share this information with others as well. We're going to keep having these just to help our customers and the broader general public to know what to do in these times, to understand what is going on, and to see us as the partner that helps them to navigate these rough times. And so please do well to share the link with people that even after the webinar, they can still join in and watch in and be educated as such. All right, so with that out of the way, we'll go right into the discussion for today. And I'll reiterate the topic, which is saying that making sound financial decisions, what to do in uncertain times. Indeed, I think everybody on the call today watching us understands primarily that we are not in comfortable times, or we are not in normal times, right? Looking at what has happened from the beginning of this year, we've seen inflation rising and rising, and right now it's over 40%. We've seen fuel prices also rising, both in the local market and the international market. Now we are seeing some respite with the fuel prices coming down. We're seeing losses with investor funds and a lot of turbulence in the financial markets. And for the layman, trying to make sense of all of this may be a little bit overwhelming. And so we want to start off on that note. Mr. Finn, if you can help us, Kofi, can you help us understand what situation our economy is in now? And then there are some terms also that are being thrown around today, such as the debt restructuring and the debt exchange program. If you can highlight a bit on that as well, that would be helpful. So just if you can just give us a brief overview and an understanding of what situation our economy is in right now.
Sure, Solomon. Okay, so yeah, we've had all of these terms thrown around: debt exchange, haircut. The fundamental issue that we're going through right now as a country is that our government is essentially unable to pay its debts and its obligations. The amount that we owe and the amounts that we need to pay as interest on that borrowing and on all of our liabilities exceeds how much revenue the government generates. And given that the government is in that situation, it is no longer able to even borrow more if it was going to take that approach to try to pay off some of its obligations. So we make money as a country, but we owe too much. And when you're in a situation like that, where the central government is the one that is under this kind of financial distress, everything is impacted. Government bonds are the main conversation we're having here in this country right now, but we're seeing it in all other areas of the economy. It's going to affect state-owned institutions. It's going to affect financial institutions who own these securities. All assets are eventually impacted if nothing is done about it. And so it puts a lot of stress on the economy and on the financial system. And until this is resolved, the economy and the financial system is not safe. And the result would be what we've started seeing over the last year and what will continue if it's not addressed. Inflation running away, heading into numbers that we've never seen before, and the CD falling to levels that we cannot imagine. So this has to be addressed. Unlike companies and individuals, a country cannot say that it has declared bankruptcy and it is going to stop existing, right? It has to continue. And so the tools that the government has available to it for it to continue existing are probably about four. First, you can try to sell off the assets that you own, state-owned institutions, other assets like that. In the short term, that is not practical, even though over time we can look at some of our state-owned institutions to sell them for whatever we can get. The second would be to raise revenue. As you all know, we've tried different ways to raise revenue in the last few years, including e-levy. The results have not been great as a way to get out of this problem. And that leaves us with three options. One, cut expenses. The other, to restructure or negotiate our debt. And finally, to get help, which for us has been the IMF option. So those are the three things on the table right now. The government has to cut expenses, the debt has to be restructured, and that is what we're calling the debt exchange or haircut. And then we need to get help from the IMF, because that allows confidence in the country and the economy to be built so that people, other financiers can provide us with some money, right? So that's where we are. And those are the options that are being considered in the general conversation right now. Where the uncertainty sits significantly is around the debt exchange. Who should be impacted? How much will they be impacted by? That's the question that is on most people's minds, and I think that's where a lot of the uncertainty is. So that's the short explanation for where we are right now.
Yeah, thank you, Kofi. And just a little bit of a follow-up on that. You did mention there's a lot of uncertainty with the debt restructuring or the debt exchange program. People are asking, and I'm sure we want clarity on that. Who is affected by this? Is it just institutions that invest on the financial market, or for individuals walking the street? Does this affect their investments as well? And in what ways does it affect them?
From where we sit, every holder of a government asset is in the conversation. And I think that's why we have all of the negotiations going on. Very gladly, over the last couple of days, we have seen that the bankers have reached some kind of agreement with the government, and the Bankers Association has accepted a certain deal. But there are other participants. So individual bondholders have set up their own association to engage on this. We saw what the unions did when they engaged the government and got respite for pension funds. You do have insurance companies and the fund managers as well who hold some of these government bonds. You have some foreign investors. There will have to be some kind of minimum critical mass that accepts a deal from the government for this to proceed. But those other conversations, I think, are still going on, even though it is our expectation and hope that this can be resolved fairly quickly in the next few weeks so that we can have clarity and a way forward. But everybody should be vigilant and should keep their eyes open is where I think we advise.
Okay, thank you, Kofi. Eugene, if you can provide clarity on this. So does this mean that for people that have funds invested in pensions, they are affected by this as well? And if so, what is Petra doing to sort of safeguard the funds of its investors?
Thank you very much, Solomon, and thank you, everyone. Yes, everyone, and I'm just to piggyback on what Kofi just mentioned, something like this is very fundamental. In fact, every individual that has any savings in any investment here, the historic nature of the investment climate in this country has been such that a lot of investments circle back to government. When government is giving you 31% and 28%, and you have a stock market that is really not performing, most people tend to invest a lot of money ending up in government. And so when you would buy a fixed deposit from your bank or treasury bills or do some long-term savings, some way, somehow, that money ends up in government security. So when government goes through something like this, everybody, whether you're a direct investor or indirect, pension funds by law are mandated to invest in the lowest of risk of securities on the market to safeguard the funds of anybody. And it's funny, somebody said that when the safest of funds become threatened, then there's no safety given anywhere. And that's exactly the situation that we're facing today. Pension funds by law are supposed to invest a majority of the funds in government security, with the caveat that government is the lender of last resort and government is the safest where you can actually put money. So government, your funds in pensions are invested in securities, and if in government securities, and if it helps you, or if it makes it a little bit more alarming, your funds in the banks and insurance and everywhere else, some way, somehow, has exposure to government securities. What Petra has been doing is direct engagement. In fact, since the second quarter of last year, when our internal analysis, we have a huge portfolio team that actually does a lot of analysis to understand what's going on and the outlook on the market to inform some of the decisions that we make. Since we got wind of this and started analyzing and realizing that there's some distress, Petra has been actively in taking the deposits of customers and have not been investing in government securities. In fact, we have been diversifying the portfolio away to alternative investment opportunities and other things that are negatively correlated to government, knowing that government was going into some distress. And since the debt exchange program was announced, Petra has been personally engaging with the regulator and with government authority through the Chamber of Trustees to ensure that the funds of customers are safeguarded. In fact, it's out of some of these engagement that we got the announcement that pension funds are exempted from this debt exchange, even though we're still going through the modalities of that. So we have been doing quite a lot of work. First of all, making sure that your funds are safe, not investing new funds in government, and also directly engaging with governments through the appropriate channels to ensure that customers' deposits are best preserved through this period.
All right. Thank you, Eugene, for that clarity. So this brings, apologies, this brings us back to what we are discussing about what to do in uncertain times. And Kofi, maybe you would like to help us with that. It seems as though there is no respite in the market. There's nowhere safe, as nowhere safe as we would put it. So as an individual investor, maybe I have some funds in an investment with some fund manager or some corporate trustee or wherever my investment is at. What do I do with my money there? And for somebody, so that's the first part. And for somebody who has some money at home, maybe under their pillow or somewhere in a safe somewhere, what did they do with those funds as well? So if you could address those two categories of people who already have funds in sitting in some investments and the market is not doing well, what happens? What do they do? And for those that have money and that is not yet invested in the market, what did they also do?
Okay. Yeah, I think, Solo, you've mentioned it, and I think everybody feels it, that there's a lot of anxiety and there's a lot of fear and the market is uncertain, right? And from an investment perspective, these are the times where if you have a disciplined approach to your finances and to your investment strategy, you will have some comfort in the fact that you've thought about it, you have executing the plan. You can speak to an expert about making some adjustments to the plan, but having a plan in place and being disciplined about it is the most important thing. Making a decision involves some risk. Not making a decision involves some risk either as well. So let's take those people who have decided that the money they have is going to sit in cash and that's it. In a 50% inflation environment, that's a very poor investment choice, right? That money could be safe under your bed, but it's earning nothing for you. Or it could be in a bank that is significantly exposed to government securities. And in that case, there is some risk around the ability of that bank to continue to stand even in the face of these stability funds that have been promised. So every decision that you're going to look at is going to involve some risk, and it requires good analysis and good judgment. There are some fundamental things when it comes to planning your investments that we will always advise. The most important way for you to manage your risk is to be diversified, right? So make sure that you don't have all of your eggs in one basket, that you have a number of different investments, and they can be with whoever your investment advisor is. It can be one entity that's managing it for you, but then it's spread over different kinds of assets. Eugene mentioned that no matter what you do in this country, you will always have significant exposure to government. That's true, but there are ways in which you can mitigate it and create some other kinds of exposure. So diversifying is the first thing. If you're not diversified, be sure to do that. The second is to make sure that you have liquidity. In a high risk environment or an environment where there's a lot of volatility, having liquidity or quick access to cash is important. Not cash that's not working, but cash that's working, which you can access fairly quickly. So there are different investment vehicles. If you look at some of our funds, you can get your money back the same day or the next day. Make sure that you have that kind of liquidity, and that liquidity is there for emergencies, for if anything happens that requires you to have access to money quickly. You have built up enough of a buffer so that you do not derail your longer term investment plans for short term needs. So making sure you have that is important. And if you don't, the time to start that is now. Now let's talk about longer term investments that you might have for longer term goals, such as your retirement, children's university education, some projects you want to do in the future, those kinds of things, right? For you to be able to achieve the best return on those things, you will have to take some risk. And what that means is that you've probably been exposed to some of the assets that have been badly hit over the last year or so, right? In those situations, time is your friend. One of the worst things you can do is you have a long-term goal, you've invested, you have suffered some diminution in value, and you say, look, I'm no longer playing, I'm taking my money away, and I'm going to put it aside. It's not part of the game anymore. Once all of this uncertainty is over, and I can say with some confidence that no matter what, it will be over. It might be in 3 weeks where a debt exchange is agreed and we can go to March and have an IMF program, or it could be delayed. But there will be an end to this uncertainty as this situation is resolved. What follows, usually, if you look at different economies that have gone through things like this, is significant improvement in the environment as an overhang is removed. And in those situations, assets will do well. So if you've taken your ball and you've gone home and you say you're not playing the game anymore, and the rebound is happening, what you've done is you've crystallized the losses and you're not part of the game when things come back. So for your longer term investments, first make sure that you're working with an advisor who knows what they're doing and they're investing appropriately for you. Even if there's been some diminution in value, refigure out and reconsider the investments that have been made. Make sure that they are strong with their advice and stay in the game, because when things turn around, you will be able to recoup some of those losses. So approaching this from this kind of disciplined perspective, I think is something that you need to do. Diversify, make sure you have liquidity for emergencies. And that liquidity, we can add things like access to loans if your emergency fund is not enough, or some kind of insurance that can cover certain things so that you're not derailed. And then be disciplined about the different goals you have and the appropriate investments that you need to have in place to reach them, and stay with the plan. That's what we would advise.
Okay, thank you, Kofi, for that. How about those individuals who are nearing retirement, right? And all of this is very disheartening for them, and they're not sure what to do. What would your advice be for these kinds of people? And maybe Eugene, you can chip in here as well. For those that are going on pensions, what should they do with their money? Because a lot of people will be coming in for huge lump sums. When those lump sums hit their accounts, what should they do? What would you advise that they should do?
I'll just take a quick stab at it quickly, and then I'll hand it over to Eugene. At this point in time, if you're close to retirement, the outcome for you is pretty much baked in. There's not a lot of time for you to make major adjustments. And so what you want to figure out is, are the investments that I have put in place sufficient to cover my lifestyle after retirement? For most of us at the age of 60, we still have some working life to go through. And so if we don't feel like we're sufficiently prepared, even at that age, let's double down. Whatever contracts you can do, whatever business you can get into to generate additional capital for yourself, properly invested so that it can generate income for you. Post-retirement is about income. It's not about significant growth in capital. It's not about taking risk. It's about income, right? Whatever investments that we have put in place for you, let's say Petra or any other corporate trustee, you have to make sure that that investment is going to be generating enough cash for you over time that will sustain your lifestyle. And there are a number of different ways you can approach it. You can either do a programmed withdrawal where we continue to manage the investment for you, but you take money out in a disciplined way on a regular basis. or you can put in place an annuity, which offers additional insurance so that if you live longer than you expected, for example, it will continue to pay you for that longer period of time. Those are the kinds of assets that you need to put in place. But most of us should not consider retirement as the end of our income generating life. We should try to work a little bit more so that we can put a little bit more aside. Because the truth is, once you go into retirement, even though your active expenses that come from working, like driving to work and back, entertaining, building business, all of that kind of stuff, even though it goes down, other expenses increase. Your social obligations, your healthcare costs, those kinds of things become part of the equation. And so you just need to make sure that you're considering all of those, and your income that you're generating post-retirement is going to be sufficient for you to cover your lifestyle. Eugene, I don't know if you want to add anything.
Yes, thank you. So I think this is one of the key reasons why these pension reforms were done. In fact, if you went on pension before 2008, you would have just been receiving SNP. With the new reformation, you have access to a lump sum, and then you get your SNP. And if you have a tier 3, there's an extra fund that you get. So you get a little bit of room to be able to plan your post-retirement life. If I were to maybe one of the places where I like to speak towards is with all these losses or these challenges that have happened over the past year. If you are in a tier 3 fund, we believe that over the next year, 2 or maximum 3 years, things will recover, right? And so to the extent that you don't need those funds, it will be prudent for you to plan your life so that you stay invested for the markets to recover. You get your funds back when you need them. But there are some places of risk for you as a pensioner, and you should be able to plan your finances, speak to our finances on the products that MD spoke about. We have financial advisors in our Petra scheme. You can speak with them to help plan out what you want to do, how you stay safe, how you make sure that you are increasing your income, and to the large extent, allow the markets to recover. If you have some funds in tier 3, there's no compulsion to withdraw your tier 3 funds out of panic or out of fear. So you shouldn't. But if you need funds to go into some business that you have really calculated well, make sure that you have some insurance, make sure that you have some regular income that comes to join what you are getting from your SNP to make sure that you keep yourself afloat until the full recovery happens. What you don't want to do is panic decisions and take decisions based on emotions and feelings, right? That actually hurts. In investment, that hurts a lot. So that would be my advice in addition to what MD has shared.
And Solo, just a quick one as well. For those who are close to retirement, it's amazing how quickly your ability to be as active as you were in your 40s and 50s, amazing how quickly that sort of slows down, right? So if your post-retirement plan includes you being very active in order for you to generate an income, you need to think about that. From 60 going, the mix of the income that you're getting needs to move from active to passive, right? The income has to be the kind where as you are working less or as you are unable to work as hard, your assets are still generating money for you that you can live on. So that is a key consideration for those who are close to or at retirement.
And if I may add, Solomon, a quick one on people close to retirement. I mean, I've seen this. I've been here for a while and I've seen this. I think the idea of the lump sum makes people very excited. I've seen people come for their lump sums and buy their dream cars, only to realize in 3 years' time that the money they are getting from SNP cannot sustain their lifetime. So just be very careful around this time. In fact, they say every cloud has a silver lining. What this whole thing that we're going through for me is pushing individuals to be very active in managing their finances and investment. And here we have on this webinar and such series and advisory services, the opportunity for you to get the information to understand and make the sound choices. You don't want to do risky things around this time. You don't want to come for your lump sum and go and buy some car and put it on the road to do transport services, and then the driver runs away or doesn't come with money, and then you are back in the ditch because you didn't ever think that you get that kind of money. So a lot of care, and that's what I really wanted to sound that warning, because I've seen quite a lot of it. People see I've just finished working. I hear I have some 80,000 or 100 and something thousand. I've never saved that kind of money for. Let me go for it and do something with it. And then 2 years down the line, they're actually back in the ditch. Because be very careful in taking risk when you are post pension. Speak to an advisor. Let the experts help you to plan out your retirement life, ensuring that you are less risky and you have secured income that can add up to what you are getting from Smith and other sources to support your life until the latter ages.
Sure. Thank you so much, and Eugene and Kofi. If all of this seems a little bit overwhelming to you, I think that the underlying message is seek advice. Don't just make any decision on a whim, but talk to somebody who knows what this is all about and can help and guide you to make the right decisions so that you don't suffer later on down the road. So speak to an advisor, a financial advisor, whoever it may be, to help you navigate this. Kofi, I'd like you to address this concern. There's still some confusion among the general public as to why investment funds are dropping, right? It's as in returns are dropping, and it is in some cases it's even affecting people's principal versus what is happening in the debt exchange program that we have. As far as I know, the debt exchange program has not kicked in yet, right? So can you help us to distinguish between the two? What is really happening now that is causing our funds or our investments to drop? And what is likely to happen when the debt exchange kicks in? If you can just provide that clarity.
Okay, so I think different classes of investments will be affected by the debt exchange in different ways. As we have mentioned before, the tier 2 and tier 3 funds that are under MPRA so far are exempted from the debt exchange, right? So what that means is that we should expect the securities that we hold in those investment vehicles to receive interest and principal when due, unless the government defaults, which there is some possibility of that happening, right? But those schemes are not exposed to the debt exchange. The reason why we're generally seeing financial markets fall is because financial markets are forward-looking. And once they began to anticipate these issues that the government of Ghana is facing, they began to price that in. They began to reflect that in the price of government of Ghana securities. And so the prices on those securities started to fall, right? In investment vehicles such as mutual funds, where the regulator started insisting that they mark to market, those price drops were immediately reflected. And so that's what happened. And that's why our investments in mutual funds and collective investment schemes started to show those falls in value, right? Once the exchange is done, those new instruments will have a price. If that price is lower than where the asset managers bought those securities, that loss that we have seen reflected in value will be crystallized essentially, right? So the vehicles are really just showing the underlying value of the investments that have been purchased on your behalf. Okay, for a lot of us in Ghana, let's make some things very clear. Most of the investments we have done historically have been investments that did not seem to fall in value. Once we made the investment, all it did was go up. That was because fund managers were managing all the volatility for you. All the underlying volatility was basically behind the veil, right? With what has happened recently, when the government of Ghana security is the one that is suffering, it is extremely difficult for that to continue. And so the underlying volatility is being exposed. Asset prices or investments go up, come down. If it is being managed properly, even with that up and down movement, you should see a general trend towards positive value, right? If it is not being managed properly, then you could suffer losses. But for the investment vehicles that we're looking at now, over the next 2 to 3 years, under proper management, they will recover. The key for you as investors is to make sure that the person who's giving you the advice is good at their job and knows what they're doing, right? And I think for me, that's the key thing that I would like to leave with you, is make sure that there's a plan, make sure the people who are advising you are good at what they're doing, and get some time. If you've run out of time, then there needs to be another strategy. But for the next 2-3 years, we should look at things beginning to recover and to get better. So where you have long-term goals, stay in it.
Okay, Kofi, thank you. There's a question in our Q&A, which is an interesting segue into what we are going to next. So I'd like to take that. This is from James, and James is asking, well, James is a little bit displeased. He's saying, please, I've listened to lots of experts in your industry, and I think that you are all not helping us when it comes to this question. And this is this question: where should I invest my money now? Where should I invest my money now? He wants a clear answer to that question.
Well, James, so you're going to have to do just a little bit of work before we can answer that question. We have put some principles down that I think you need to look at. The first thing I'll ask you is, do you have an emergency fund? And is it invested in a liquid, high-quality asset? If not, that's where you should invest your money now, right? If you have that in place, then what are the other key goals that you're investing towards? So for your retirement, if you're asking this question from Ghana and you're formally employed, you have something that is in tier 2. And as we've already mentioned, that is currently exempted from the debt exchange. And so the values that your pension trustee are showing you are probably the values that you will get if you were to redeem it now. That is going towards your retirement. You need to ask yourself the question as to whether when you forecast it to your retirement date, or when you are now not actively working, the amount that money represents is going to be sufficient for your retirement. If it's not, you need to top up. The best way to top up is to do that through tier 3, which also gives you some tax advantages. When you invest in tier 3, up to a certain limit, you are not taxed on that money by the government. So that should be the next thing you do. And that should be for additional long-term purposes like retirement. All your different goals that are key to you: housing, children's education, a car that you might need, retirement. You should have a specific plan and specific investments that are catered towards each of those goals, and have an estimate of what amount you're going to need when you get to that point in time. Calculate the gap and make all the efforts you can to get to it, right? So what should you do now? That's the general advice. Which instruments should you use to achieve all of this? You can talk to some of our advisors and they can help you with options, high liquidity safe funds for the short term, and quality, more aggressive funds for the long term. For example, we just introduced to our customers late last year a dollar-denominated investment vehicle. You pay in CDs, you get your money back in CDs, but it's invested in dollar-denominated instruments. And so that gives you some kind of protection and income in dollar terms. When we put that investment out, dollar was around 14. Over the next ensuing weeks, 14 CDs to the dollar. Over the next ensuing weeks, we saw that the CD appreciated. Dollar came down below 10. If you were looking at your investment in that vehicle, you started losing money, right? Some people panicked. For those of us who were taking the advice of our advisors, we actually kept on investing, because if we wanted to buy dollar at 13, 14, and dollar was now at 10, it's cheaper now, isn't it? As the CD has started to weaken again, those investments have returned. The cost that we took that investment at is lower because we were able to get in at some of those lower prices, and now we're seeing those gains come back. That investment is an investment for a 2-year horizon or more. I won't advise you to put your money into that investment if you need the money in 3 months, right? Because it's going to be volatile. But we can say with a very high level of expectation that if you have a goal that is 2 years out, that is a good investment for you. But looking at the mix of it and getting the right balance requires you to either be good at this or to get some advice. And that's what I would suggest to you.
Yeah. Okay, so I'll just add a little bit to it. I think the reason why, on top of everything that Kofi has said, the reason why you should invest is because of Investment Advice 101. And I'm sure we've heard this quite a number of times. And this actually helps us to deal with a lot of the hygiene factors, what Kofi has spoken about, having a plan, knowing that you have catered for yourself, emergency funds, long-term funds. But basically, Investment 101 says you should buy low and sell high, right? If you have a very good horizon, you understand where you want to go and how you want to get there. When markets are like this, is the best time to buy because assets are distressed. They are selling it for cheap, right? But when you think about it, I buy today and I look at it tomorrow, markets are still not looking so good. We are still low. Most investment advisors say this was the best time to buy. Like Kofi was explaining, when this dollar fund was set up, the dollar was trading at 14 cedis. Probably not even the best time to buy if you're like very savvy. When it dropped to below 10 was the best time to buy. And then wait, because once all the indicators say it, and investments markets go down and they rise. It's been the nature of investment since the dawn of time. Markets go down and they rise. You want to buy when the markets are down. They will rise at some point. We believe in the next 2 years, markets will return to normalcy and begin to show some of these recoveries that we're talking about. And so that's why maybe you are hearing that people say you should invest now because assets are depressed. Now people want to sell, they want money, so they are willing to give you a lower price. If it is like a bond or a security that is 100 cedis, they are willing to sell it to you for 60 cedis or 40 cedis. Think about it. So far, are willing to wait out. You already have 40 cedis as benefits for buying today, right? But if you think about it, I bought it today and tomorrow is only 42 cedis or it's going to 38 cedis, I've lost some money. Well, you're not looking at getting your money out now. You're looking at the horizon of when the market begin to rise and confidence around when it is going to rise. So I think we've said it and we've designed and have a number of products that cater to certain needs over this time and for everything that you would need it for. We have a plus income fund, which is a fund that is very stable for your emergency fund. You can get your money within 24 hours. It's very stable, less risky. We have plus balance fund, which serves for long-term goals for when you have them. We have the savings booster, which is heavily pension linked for those who really believe in the strength that pension funds have towards safeguarding your funds. We have the Eurobond dollar denominated fund. We also have life insurance products. We have guaranteed sum products, and we have pension-backed loans, pension-backed mortgages. In fact, these products were designed for times like this when you actually need liquidity. You have funds in a long-term investment and you don't want to break that fund because of the value that you want to get in a long term. So we have a pension or asset-backed loan that you can access within 48 hours from Petra based on the assets that you have with us. So then when you need the money, you don't need to break a long-term investment when markets are low. You can actually access a loan to meet those liquidity needs that you have today. We have pension-backed mortgages or asset-backed mortgages. Again, tapping into the opportunity that real estate offers around this time. You can, based on your pension assets or your investment assets with us, access mortgages to purchase property, land, or anything. Just talk to an advisor with us and we'll be able to help you to rationalize this decision and fit squarely into your individualized plan that ensures that you are financially healthy around this time. I believe the advice is simple and consistent. Please talk to an advisor around this time. You need experts. If you don't trust the ones that you are working with, please seek out another one. What you shouldn't do is to take these decisions on your own. You are an expert in your area of work. We are experts in managing your finances. And so speak to us and we'll actually help you to make the right choices around this time. What we are saying is then don't panic. Around this time, I always say that investments, there is that intuition that you use to do leaps and bounds, the gut feeling that high-level investors have that they make big choices with. Then there's logic and reason where you look at data, you look at information, and you use it to make objective choices. The least of them is feelings and emotions. And that's what a lot of people are doing now. I don't like the way the thing is going. I just want to go take my money and come and put it under my bed. Inflation, by the way, is eating away your money, right? So we are the second level, I believe. Talk to the experts, people who have the information, who analyze the data. As I said, we have a portfolio team and a team of analysts that actually analyze the market, understand investment. We have fixed income products available for people who have a sense of the fears of open-ended investment unit trust or funds that we also have. So you can actually buy a fixed deposit with a bank that our team have analyzed and are confident that they will be able to pay your money back, and other fixed income securities that help you to deal with certainty around these uncertain times. So please speak to one of our experts and don't take these decisions alone. That would be my advice.
Thank you, Jim. Before I let you go on that note, there's a question that I'd like to direct to you. Catherine is asking, so we've been saying a lot about getting advice. She's asking, how will you know if the person you're talking to is the right person, or they know what they are doing? And I think it's a very relevant question to ask in these times. So usually, if you can ask, help us.
It is a very relevant question when it comes to analyzing investment or fund managers or investment advisors. Basically, I believe history is the best teller and what they have in place, right? Look, I think the base of it, we had some time ago, we had the issue with microfinance institutions. Remember, over the past 10 years, we've experienced microfinance institutions taking people's deposits and all the things that happen with it. Then we went on to investment institutions, the securities companies, and then we had the banking crisis. The pensions company, and if I may be bold enough to say, Petra has actually kept people on a very decent growth trajectory all throughout these periods, right? And if that is anything to go by, I should be giving you enough confidence to say, these guys know what you're doing. So if you had your money with a microfinance company, you lost some money. If you went to give your money to some of these investment companies, you lost your money. If you had some investment in some of these distressed banks, you lost some money when the banking crisis happened. If you had your money with Petra for the past 10 years, you have seen a decent growth over of your funds up to now. And that will be, for me, the best testament to whether your investment advisor is good or it's not. Secondly, you look at what they have in place, how they perform. Try and ask questions to understand. And if you are not comfortable with those questions, please make a change. That's what we are trying to push everybody to take an active role in managing your finances. Ask questions. If you are not comfortable with the answers that you are getting, look at the history. If it's not helping you, play it safe. Find somebody that has the good history behind them, somebody that is well set up and can actually offer you what you need to steer through the time. So I think that's the best testament I can say to that. Maybe there are other ones if we can help to add to it, but for me, the history is the best gain. And if you look at the past 10 years, what Petra has done in the various funds and the various products that we've put out there and the value that it has brought customers, even through the hard times, right? Through microfinance, through the banking crisis, through the investment house crisis, even up until now, it should tell you that these guys know what they are doing and they can help you to steer the times. And that's how you choose an advisor. Not to say that, minuses don't happen over the period, but you look at it over the period, over the 3-year, 5-year, 10-year period, and look at what you've gained and what you need to do and what they are telling you, whether they seem to understand what is going on, they seem to have the best advice as to how to get out of this, and then you sort of go with them. So that would be my advice on how to determine. Maybe Kofi can add to it for us.
No, I think you've covered it all. What we might want to do actually is put a paper on our websites that actually takes people through some of the questions that they need to ask when they're looking for an advisor, and those are the questions that they need to get comfortable with the answers, whether they're talking to Petra or any other investment house. I think providing people with guidelines for what they should look for, the questions they should ask, and the evidence that they should want to see before they make a commitment. I think that'll be good. Because when you pick an advisor, it's, a relationship with a good advisor, I don't want to call it a marriage, right? But it's not a short-term thing. This person is going to be with you as you go through life and as things adjust and change, right? Telling you, you have a new child, what do you need to do? How do you cater for that child's future? What amount of insurance do you need to make sure that if anything happened to you, the child is still taken care of? If you get married, any of these life events will require some adjustment, some change, and some insight, right? So it's a very, very important decision. It's not It's not a trivial one, and it's one that you're going to have to stick with for some time. So we'll put some educational material on our website, or for those of you who we have contact information for, we'll send you some information that will guide you as you go through this process. And we will encourage you to quickly do something like that, right? Because the one thing that we haven't mentioned when it comes to investments, outside of expertise, opportunity, return, the most important thing is time. The most important thing is starting early, being consistent, and letting returns that you accrue early get to work and generate additional returns for you. The power of compounding is what we're talking about. So let's not treat this as something that we will do sometime in the future. Getting our finances in shape. We have a crisis that is going to catalyze this and force all of us to review the state of our investments. Let's take that action now, and let's make our money begin to work now so that we can have a bright future. Thank you.
All right, thank you, Kofi. This next question is for you, but before we take that question, I just want to let our audience know that there is a survey link that we've put in the chat. We would implore that you click that and then follow the survey and answer some questions for us, just to help us to understand whether what we are giving to you is providing value and how we can be better at it. So please take just a few minutes to just take that survey. But this question is coming from Edward, and Kofi, I think you would help us with this one. It says that we have heard in the last few days that government has reached some agreement with the banks regarding this domestic debt exchange. Now, I'm wondering how my bank can reach an agreement with government on my behalf without consulting me. It is public knowledge that no bank has its own money, but rather monies of individuals. I need a little light thrown on this, please.
Okay, all right. That's an interesting question. So I'll just answer it quickly by sort of making a comparison between, let's say, tier 2 pension funds and tier 3 pension funds in the bank. When you contribute to us at Petra in tier 2 or tier 3, or when you contribute to a mutual fund, that money does not belong to the trustee or the fund manager. It belongs to you. It is being held in trust for you. All the gains and losses are yours, right? The fund manager or trustee just has to do a good job of managing that asset on your behalf. When you give your money to a bank, that money belongs to the bank. You have essentially lent the bank money. When you put money in a savings account, a checking account, a fixed deposit, you have essentially lent the bank money. The assets that the bank is going to use that money to acquire are the bank's assets. They don't belong to you, right? So all of the government bonds that the bank has bought with money that you gave it are bonds that belong to the bank. That is why when it is time for you to go for your money, the bank is not telling you about gains it has made or losses it has made. It took your money under certain conditions, and now it's giving that money back to you. Okay, so the decision about debt exchange on the banking side does not require a conversation with you as a deposit customer of the bank. When it comes to those of you who have purchased government bonds through the bank, in that case, that asset was purchased by the bank on your behalf. So they were acting as an agent for you. That investment is yours. And that is why you need to be part of this domestic bond association, so that the power of those numbers can help you engage with the government in this debt restructuring conversation. But for the banks, we as depositors to the bank have no say in it. The most important thing that we need to do and understand is to make sure that the impact of the debt exchange on the bank that our money is with is not a lot. It will not put that bank into financial distress, because in that case, you might have a problem. I hope that answers the question.
Yes, thank you, Kofi, for that. And there's another question this person is anonymous. You didn't show your name, but the person is asking, growing up, we've been told that government securities are risk-free and are safe. However, with all that is going on, it seems as though that assertion is not entirely the case. The question I want to ask is, what are our options outside of government investment products? Is there anything that we can put our money in that does not involve government, and are they safe?
Well, yes, there are investments that you can put your money in that do not involve government. Even though, as I said at the beginning, in the economy, when the government security is the one that is facing crisis, everything is impacted, right? So banks, insurance, everybody's going to be impacted. At the end of it all, for banks, for example, those which have strong balance sheets or which have access to additional capital that can allow whatever fall in value of the assets they hold to still make them a going concern are those you can keep your money with. So high quality banks that are going to go through this debt exchange and come out safe, you can do some fixed deposits with them. And just make sure that you're diversified and you don't have all of your eggs in one basket. Up to this point in time, Treasury bills have been excluded. Given how many times we have changed who is part of this debt exchange and who is not, there's still some uncertainty in our minds about Treasury bills. The likelihood that they will be included are very low. There's some risk to that, but those are an option as well if you're willing to take the risk because the rates are high. Our advice to you would be fixed deposit in a high quality bank over Treasury bills at this point in time. And then when the debt exchange is over, we can look again at Treasury bills. For those of you who have enough capital sitting around, real estate is not a bad option. Unfortunately, today, we do not have any collective investment schemes that can give you exposure to real estate. So you're going to need a certain minimum for you to be able to get access to that asset class. Or you can join with some of your friends. You know, if an apartment is $150,000 and each of you has, $10,000 and there are 15 of you, you can get together and buy a home under the right structure to make sure that nobody cheats the other and that everything is fair. And that's also something that we can probably advise on. And buy the apartment together and all of you share the income and the gains under some proper governance structure. Sometimes it's difficult to do these things with friends, and so ideally you want to do it alone, but you need to have the amount of money to be able to do it. But diversifying across some fixed deposits, some real estate, we have some corporate bonds that are still doing well. And then the fund that we have that invests in Euro bonds that are not Ghana Euro bonds at this point in time. I think those are all different options that you can look at this time. Once we go through this and there's clarity, the investment options, I think, become a lot more open. Once we go through the debt exchange and the IMF deal is announced, we have a lot more options to deal with. But at this point in time, safety is key, diversity is key, liquidity is key, and that's what we'll focus on for you.
All right, thank you, Kofi, for that. There's a question that I'd like to direct to Eugene, and this person is anonymous, but he or she's asking: is it true that 10% of our savings with Petra have been deducted and given to government in order to save our economy?
Okay, so that that is absolutely false. It's not possible. First of all, due to the way pension funds are set up, we operate under NPRA, and there's a government law from Parliament that literally dictates pretty much everything that we do. As MD was saying to us, the funds that we receive from customers, they belong to customers. They are given to us in trust, and our job is to manage it on behalf of customers. Indeed, within the remit of everything that we can do with your funds, it is actually supposed to be to the benefit of the individual, and outside whatever the laws and the provisions give us, we can't do anything without you customers or a client's consent. Even that must be within the remit of the law. And the NPRA, the government law that NPRA regulates for us, is quite exhaustive and comprehensive. as to what we can do and cannot do with funds. In fact, I believe it is one of the main reasons why pension funds have been fairly safe over the period, even up until now, and continues to have the safety due to the nature and the structure and the setup of it. The fund sits with the banks as custodians. The investment decisions are taken by fund managers, and we as trustees ratify those decisions and provide clarity, statements, and visibility to our clients and our customers. And so we don't have the room to do this. We are supposed to provide reports every month, and MPRA actually come to inspect the nature and everything that we have in our portfolios for you. So we are unable to do such a thing in any way, shape, or form. The law cannot allow us to do it. The structures cannot allow us to do it. And our fiduciary role to you as a customer, we're actually here. So I don't know if people know, but pension funds or Petra Tier 2 pension companies are not government institutions. We are a company that is mandated to manage your funds for you. We are not a government agent, and we have no alignment to do anything in favor of government. In fact, we are using government provisions to safeguard and provide your money for you in the hope of doing more business with you and to grow our wealth. So that cannot be anywhere near any truth. Thank you.
Thank you, Eugene, for providing that clarity. Sami in the comments seems quite interested in the dollar-denominated investment instrument Kofi mentioned earlier. So he's asking, what do I need to do in order to invest? Eugene, if you can give some guidance as to what this person can do.
Yes, the first step is to just call in and speak to one of our advisors. This fund is, as Kofi explained, is dollar denominated. You pay in cedis. The investments are done in dollars, and you redeem in CD at the dollar equivalent at the time that you are redeeming. It's a very straightforward process. You basically, if you don't have an account with us at Petra, we set up an account with you. We take your deposits, and then we basically put in the investment for and on your behalf and provide visibility over the period. And so please speak to any of our advisors, reach our hotline, and our advisors can help you to take the. And this actually applies to all of our products, which provide the diversification that we spoke about. In fact, our back end work has been to try and open up some of these opportunities. So for example, today, you can access 100% mortgage. Up until now, you have to pay at least 20%. And then the bank will finance the other 80% from you. But today you can actually access 100% mortgage based on your assets that are with us here at Petra. Whether to buy a land or to buy a house or to complete your house, you can actually access a mortgage to do that. So you can speak to an advisor, and that will help you to take advantage of the real estate opportunities that exist today. We also are working and are close to finalizing some fixed income, fixed deposit with banks that we have researched and are comfortable to make placements with them and can make those investments for you. When we talk about your emergency fund, don't leave those money sitting down. We have PIF, which is a very stable fund with low returns and low risk actually, and to help maintain your money, and you can access it in the shortest possible time. So please speak to any of our advisors, reach out to us on the numbers on the screen, or just Google Petra and call us, and our advisor will attend to you. Thank you.
Just to follow up as well, Solo, Eugene, just to add to your point, for those of you who want to go and just have a completely digital option, you can use the Achieve app as well. Both the Plus Income Fund and the Eurobond Fund are on the Achieve app. The Achieve app allows you to set up goals for different purposes and assign an investment to it. So you can actually set up a plan for yourself on the Achieve app if you are so inclined to, if you are confident in your ability to put a plan together. And that way, it's just on your phone, you manage it, you can fund it directly from your bank account or from Momo very, very easily. So that's another option as well.
Thank you, Kofi, for adding that. We'll take one last question, and this is from Facebook, and we'll dive into a few other areas I want us to cover, and then we'll come back to cover a few more questions, and then we can bring the webinar to a close. But this question is coming in from Facebook, and this person is asking, what is the limit of investments that is tax exempt? So just to sort of clarify a little bit more, what kind of investments are tax exempt? And what are the limits to that in terms of how much money can I put away that will be tax exempt? So maybe Eugene, you want to address that.
Okay, please clarify. Are we talking about tax exemption contributions, or we're talking about investment tax exemption contributions?
Yes. The person uses investment, but I'm sure they are referring to pensions.
Okay, so the laws of this country allow us to contribute up to 35% of our gross basic income tax exempt. After that, you will have to pay taxes. So basically, you have SNET, which is 12.5%, and you have your tier 2, which is another 5%, and you have your tier 3, which can go from 17 all the way to 35% based on the allowances that your employers allow. So if you don't have a tier 3 scheme, you can actually still contribute to a personal pension, which is a savings booster with an exemption from your taxes without having to pay tax before you use the money to make that investment. So the law allows you to contribute up to 35% tax exempt.
Okay, thank you very much, Eugene, for that. So I wanted us to focus a little bit more on, we've been speaking about individuals for quite some time now. I want us to just shift focus to employers and what they also can do in these uncertain times. So the question is, for employers who have a lot of staff on payroll, they are seeing returns for the contributions they are making for their staff, both tier 2 and tier 3 dropping. What are they to do? I remember one such employer having a concern whether they should stop contributing totally, or they should still keep contributing to these funds for their employees. What would be your advice for employers who find themselves in this situation? Please, Kofi, Eugene, any of you could take this.
I'll leave it to you, Eugene.
Okay. So yes, I think I get this question a lot, so I'll answer it. Basically, our tier 2 and tier 3 funds are set up to be long-term funds. Tier 2 from the time you start working, in tier 3 from the time you start working, if your employer allows you to, right? So all these funds are long-term, and long-term funds benefit from the compounding effect that Kofi spoke about earlier. An intermittent drop is a very minimal drop when you look at the long-term effect. I was explaining just with the scenario. So if you are contributing 200 cedis a month in a fund that is over like 10 years period or even over 10 years, when you stop contribution somewhere in the middle, let's say around this time, you say, oh, I'm not going to contribute because the fund is dropping, right? You may miss out on 1,200 contribution, let's say 2,400 Ghana cedis contribution, because it's 200 cedis per month. Now that 2,400 that you stop contributing somewhere in the middle, at the end of the period would culminate in a loss of about 12,000 Ghana cedis or more, right? Because you fail to get the compounding effect that it adds to the end of the gain. However, these drops that we talk about, or these things that have happened over the past couple of months, as we said, the markets will recover over the horizon of the fund, unless maybe your horizon ends in January. That's a different story altogether. But they actually do recover. So I always tell them to look at it over the 10 period, look at it over the period and understand the growth of the fund. So you see a typical contribution for a 10-year period, you realize that the contribution itself is about 15 to 20% of what you get. And the return is about 80 to 85% of what you get. So if you look at the time that you are contributing, the total money that you paid to Petra is about 15 to 20%. However, the total return or benefit that you get at the period is 100%, which is about 80 to 85% of your money. And so when you when you take such intermittent actions in the middle, what happens is that you lose out on the consistency, and in the end, the losses become bigger, because the loss becomes huge because of the compounding effect. 10% of 1,000 cedis is different from 10% of 10,000 cedis, given that the returns are constant. So you, first of all, the law does not allow you, because this is a social security and a social safety net fund. And so it's not a smart thing to stop investing around this time. Look at it over the past 5 years, 3 years, 10 years that you've been in the fund. Look at the returns, and over the horizon, they recover, and then you lose a lot if you stop investing. So it's not a smart decision to invest. You realize that that is purely based on feelings and emotions rather than information, as I explained before, or data or facts. So look at the facts and the data and let the information actually guide the decisions that you make. If you take emotional decisions like, oh, because it's not doing well, I'm not going to invest, you may never come around to invest again, right? And we've seen that, right? And then you end up, somebody stops from one employer, go to another employer, and the employer is not doing tier 3, and then they don't continue to do investment, and all that they have is the historic investment that they have from their first employer. They come to pensions time and they are tier 2, they have some lump sum. Tier 3 is next to nothing, and they're like, if I knew, I would have continued to do those investments myself, or those contributions myself. So those are some of the things that I will sort of point to when it comes to continued investment. Consistency is key in a long-term investment when you are talking about horizon. The amount doesn't really matter, right? So somebody can give you 10,000 cedis today. It doesn't make up any difference to somebody who has been contributing 10,000 cedis for the past 10 years. This person has a lot more returns than you that you pay 10,000 cedis today. So it's the consistency that makes the difference because of the compounding effect, and not the one-off payment. So don't break investments, and don't stop contributing around this time. As we spoke before, today, when you have a long-term view of the market or a long-term horizon, these contributions now are actually going to help you because assets are depressed. The market is low. So your money is actually going to buy something that's undervalued. And when the markets return, you are going to gain on the value, if you understand what I mean. So that's my advice on that.
Thank you, Eugene. So we'll take just a couple more questions, and then we can bring the curtains down on today's webinar. But just a few reminders to everyone on the call. We've shared a link in the chat to take a quick survey to just help us to improve on what we are doing and to increase the value that we give to you. So please take just a few minutes to answer that as well. We've shared some links as well in the chat that will lead you to some of the products that we've mentioned here on this webinar. If you're interested in getting a loan, if you're interested in accessing a mortgage, so the pension-backed products that Eugene spoke to earlier, we shared those links, and you can read about them on the website and get some understanding, or call somebody from there as well, and we can engage with you on that a bit more. So I'll take quick questions coming in. So this person is asking, if I'm leaving Ghana to study or work abroad, and I'll be staying there for quite some time, how would you advise I manage my existing pension scheme, primarily with SNIT and other corporate trustees?
Okay. So I'll give a little advice on that. So if you are leaving the country and you have intentions of returning, right, it's the best choice to stay invested and have a plan. Maybe speak to an advisor and make sure that you have a plan and you understand what happens to your investment over the period. In very rare cases where people leave and decide that they're going to be there for the rest of their lives, and in fact, the law does not allow until I believe you are 60 or you have documents that shows that you are completely out of the economic system or the social security of this country. So you really can't access especially things like your SNIT. You can't go on early pension if you are leaving the country and are not returning. You have to wait till you are 60 and come back, and that requires a certain number of years of contribution before you can actually access it. When it comes to tier 2 and tier 3, the funds belong to you. You have every room to decide what to do. Tier 2, you can't access them until you apply for early pension, which is like 50 years. Tier 3, you can access them today if your employer allows you. But what I normally advise because this will always be home for most people, it's always good to have something that is actually earning some returns for you whilst you are away. So you don't go and tour out there and come back to nothing, as it were. But again, make sure that you have the accesses to monitor what is going on and to take corrective actions when you have to get to an advisor. Make sure you have access to your fund. You receive your statement. When you want to do an individual top up, you can. Because if you have a 50,000 Ghana cedis here in a tier 2 fund or a tier 3 fund, and you go out there and you go and study and you work and you stay there for the rest of your life, it would be good if you came back in some 20 years or some 10 years time and find out now your money is 90 something thousand or 200 and something thousand. It's not money that you thought you had, but it's there for you, right? But if you took it now and you went to spending, well, then your eggs are all in that outside basket. You better make sure that sort of delivers, right? So that's what my advice would be on that.
All right, thank you, Eugene. Just quick reminders again. This webinar will be shared on our YouTube page, Petro on Social. So even after this, you can share it to your friends and family as well, so that they can get some knowledge and some value from what we're discussing today. I'll ask Mr. Finn one last question, and then maybe we can bring today's webinar to a close. And it's nothing serious, Mr. Finn. We just want to know what your thoughts are with regards to everything that we discussed today. In conclusion, what would be your summary of all that we've said and advice to people on the webinar today?
Okay. When it comes to personal finances, it's a very difficult thing for us as individuals to deal with, and it's not just a Ghanaian thing. It's a human thing. Most of us would like to leave it. It's complicated. It can be uncomfortable. If we do the analysis and we find out that our expectation for where we wanted to be will not be met, it can be disappointing, right? A lot of us will spend more time researching a car than thinking about how we are invested. My appeal to all of us is that let us take the next couple of days and let us act on making sure that our finances are, that at least we understand them and that we are taking the steps towards putting them in the shape that can get us to where we need to be. If all we do after this webinar is to take one action and say that I'm going to go and check and make sure that I have an emergency fund, that if anything happened to me, I have put aside enough to cover my expenses for anywhere between 6 to 12 months, right? And that is a form of security for me. If that is the only thing that we did, we've taken an action that is extremely important. Once you take that action, the rest will become easier to take, but we need to act now. This is not a tomorrow or next week kind of conversation. It's a now kind of conversation. So in as much as we are worried, we are concerned, we don't know the questions to ask, we don't want to sound silly when we ask those questions. We're afraid of what we might see if we go and look deep into the numbers. We still need to do something. Let's do it. Let's walk away from here deciding to take some action. Where we have some difficulty, like we've said, talk to an advisor. If you feel like you're in a position to make the decisions yourself, go ahead and do it, right? That will be what I will leave you with, is let us not be passive about it. Let us be active. Let us take control of the future that we desire through the financial decisions we make. Thank you.
Thank you to Mr. Finn. The time to take action is now. Mr. Virukwan, any last words for us? Your concluding thoughts, please.
Yeah. So I mean, my last thoughts will be, I'm actually happy. Every cloud has a silver lining, and I believe that what is happening, the silver lining will be the encouragement or individuals taking a little bit more active role in managing their finances. We are all trying to get out of poverty, drive some generational wealth for ourselves and for the next generation. That has been the problem for us in Africa for the years. So it's very important that we begin to set up. For where I sit and what I've had to deal with, I see the pain and the loss. People, for lack of financial knowledge or advice make a lot of wrong choices, and those wrong choices hurt families. For example, you have old parents around this time, you are trying to build your investment. You don't have a funeral plan or an insurance plan for them. Something happens at home and then you need to come and redeem your funds and go and do a funeral for your uncle or your mom or your dad. And even though that's an emotional, painful part of your life, it sort of sets you back in your investment plan. You could actually have like a funeral plan, which is sold. It's far less than how much you have to redeem to go and pay for something like this. And because you don't know, you just come and redeem your tier 3 funds to go and do a funeral for your parents. Child education, putting money away for this purpose or this other purpose. This is the time to actually take an active role and make some of these sure choices that help you to manage your finances better and ensure that you get what you get out of the hard work that you are doing. What really pushes me back is to see that people's hard work, their sweat and tear is actually going away for things that they could have actually changed fairly easily, right? And so let's take those advices. Today, some of these things are very real for us, right? I come and take all my money. I want to go and buy a piece of land, and then the land went away. It went into litigation, and I've lost everything. And that's a big loss. You can't sort of recover from that. But there are products that can help you to achieve these goals without having to risk everything that you have, because it's in your knowledge that you can just use your savings to do that. So speak to an advisor, take an active role in your finances, and we will be able to get to a much more healthy place, both for yourself and for our society. We are here. We've been on this journey from last year, and that has been Petra's goal, to help you to achieve more in better ways. So please speak to us and do not take these decisions on your own. Most importantly, don't take emotional decisions or panic decisions. When these things are going on, it's most important for you to be very calm and to sieve through all the noise and understand what is really going on. Every investment has an underlying vehicle or instrument, and you need to understand those vehicles. Otherwise, you end up making a lot of wrong choices and suffering the consequences. Thank you very much. And I hope that this webinar was informative, educational, and insightful. And there will be other ones that come along the way. Solomon.
Okay, thank you very much, Eugene. We would like to bring today's discussion to a close. We understand a lot of questions have come in. We do acknowledge that both here and on Facebook and on YouTube as well. Please, if your question was not answered, do not despair. In the course of the week, we will have people reaching out to help answer some of these questions as well. So do not think that we've sort of abandoned you. But I believe that this webinar has been helpful. We've learned a lot. Myself, I have learned a lot, and I trust that we are all walking our way more knowledgeable than we came in, and more guided for what we want to be doing in these uncertain times. We want to encourage everyone on the call, everyone that was listening to us or watching us, that as Kofi said, the time to take action is now. Let's not delay. And if you didn't hear anything at all today, at least walk away with this, that you need to speak to somebody to help you make the decisions that will affect your life in this time. So let's take these things to heart. As we mentioned earlier, this is a series of webinars that we are hosting to help the general public and our scheme members to make sense of what's going on and to make better decisions. This is not the last in the series. We'll come your way again on another topic that will help you further down the line. But we appreciate your time, and we thank you for making the time to join us. My name is Solomon. I've been your host, and want to extend thanks to our panelists, Mr. Kofi Finn and then Mr. Eugene Burukran for engaging with us and helping us to navigate these questions and helping us understand what is happening. Gentlemen, thank you so much for your time. And for everybody that joined us, thank you too for your time. Until we meet again, we wish you the very best in all your endeavors, and have a safe one today. It's bye-bye for now.
Bye, everyone.
Thank you.
Lucky,
Hi, Solomon.
are we done?
Thank you so much. That was really great. Yes, we had done.
Okay.
I think Kobe and Derek has left. Yes, thank you all so much. So, we'll continue the rest of the week. Thank you so
Thank
much.
you very much.
All right, we'll talk later. Hi, Eugene.
But we didn't have the products displayed.